So I'm at a used car dealer auction today, and a lot of these cars that you see behind me are repos. And what we're seeing right now is that we have the highest level of auto loan delinquencies that we've ever seen here in the US. And we have something very interesting that's happening. CarMax, Carvana, the two largest used car dealers here in the United States, their auto loan delinquencies over the last few quarters have spiked, but their repo rates have stayed flat. How can that be? They're actually putting a band-aid on a terrible situation to try to hide the numbers. And to make the situation even worse, you have banks like Wells Fargo that are actually loosening their loan requirements to even get an auto loan. This has to end well, right? All right, so now what's going on? You have CarMax and Carvana who have recently showed numbers where their auto loan delinquencies are going through the roof. And this is people that are not making their car payments. Now, CarMax, they write a lot of their own loans. They hold their own notes. All that means is that they're basically big, glorified, buy here, pay here used car dealers. You know, the dealers that you see on the side of the road, they have $9.95 down on their windows. You can put $1,000 down. You can make monthly payments of $350 a month, and you drive a car. That's basically what CarMax and Carvana they're doing, but they're just doing it on a massive, massive scale. Now, here's the difference between CarMax and Carvana and these small buy here, pay here dealers, which is what a lot of these repos that you'll see behind me, we'll talk about that in a little bit, how that's where these repossessions are coming from. Well, with CarMax and Carvana, they have shareholders. They have stock prices that they have to pay attention to, and they have to keep as high as possible. So what doesn't look good for a car dealer? Well, that's when you have to take back a lot of cars. And when you do that in a downtrending market, when wholesale prices are going down, yes, wholesale prices have been going down over the last year or so. And we can see that in the data. Cox Automotive releases a lot of this. What you see is that, okay, you're going to end up losing a lot of money because there was a lot of people about 12 months ago, about 18 months ago, that were paying way, way, way over value for a lot of these used vehicles. And those loans are the ones that aren't getting paid for right now. So if you have this big wave of repossessions that's hitting the car market, well, all of those vehicles are worth way less than what they were 12 months, 18 months. And a lot of these consumers are underwater right now. And when you have all these repos that come through the system, well, Carvana and CarMax can actually get hit pretty hard by losing a ton of money by going to pick up these cars. And what we also know about repossessions is that when people stop making their payments on these cars, well, they stop taking care of them too, because they know that they're going to lose these cars. So why would they keep them up? A lot of repos, in the case of my car dealership, when I come here and look at cars, it's very rare that we'll even look at repossessed cars because they are the worst of the worst and worst. And I buy and sell cars that are $5,000 and under. So that should tell you volumes, speak volumes of how bad these repossessed vehicles are. And I'll go up here and I'll show you a couple of them whenever I walk up this hill right here. But this is something that's very interesting to me because I see in the market, this whole row right here, all repossessions, I see in the market that repos are on the rise from the subprime lenders, which are these buy here, pay here dealers. These subprime consumers, they aren't making their payments. These are the same consumers, these buy here, pay here dealer consumers. These are the same consumers that are buying cars from CarMax and Carvana. So if their auto loan delinquencies are going way up, but they're not going to get the cars, they're just avoiding something that's the inevitable. They're trying to either squeeze as much money out of these consumers as possible. Maybe they can get them to pay 1 or 2 more payments over the course of the next 6 months, over the course of the next 12 months, to try to just squeeze a little bit more money out of them, or they're doing what I think is the thing, and they're just trying to kick the can down the road and say, oh, well, we're doing okay right now. There's not an auto loan crisis. There's not a repo crisis. We're not having to deal with that right now. And you can see because we're not repoing cars. But we all know the truth, right? Your auto loan delinquencies are going crazy. People who owe more than 90 days worth of back payments right now are spiking. People are not making their payments, and if you're not going to pick up the cars, then you're just delaying the inevitable. And check this out, just to make the matters worse, what we have is we have banks that are already loosening their lending requirements. You have Wells Fargo that just came out, and car dealership guy reported on this, that we have Wells Fargo that is actually decreasing the credit scores needed to get some of these loans, and not even that's not even the worst of it. They're going back to where they're loaning on more than what the car is actually worth. LTV is loan to value ratio. And in a lot of cases across the car market, what you want to be at is you want to be at between 80 and 100% of what you're actually loaning on the car for it to be a secure loan for the bank, the lending institution, whoever is actually writing the loan. But they are increasing that to the subprime of the subprime, the lowest level of borrowers that they will allow to get a loan. They're increasing that to 110%. But listen to this, just the smidge tier higher than that, I think it's like a 540 credit score. Subprime, still, that's the realm that we're in. They're actually increasing their loan to value percentage up to 150%. What got us into all this mess? It was banks allowing consumers to borrow money way above what the car is actually worth. And this creates a whole different kind of situation here in the car market. Not only are you having foolish people signing up for loans that they can't afford, but two, you're allowing dealers to come in and get 150% of the value of the car and get it to these consumers. I give you an example of this. So say this F-150. This is a trashed F-150. We're just going to use that for the example. Let's say this on the book, the value of this vehicle for loan value is $10,000. Well, a consumer can walk into a car dealership, and because that car dealership knows that they're hooked up with Wells Fargo and that they're able to get the loan value of 150% on that F-150, they can actually sell that F-150 for $15,000. So that consumer now is getting into that car for $5,000 more than the car is actually worth. So here's where the setup for disaster is, and now why we're living this auto loan delinquency nightmare here in the car market is that consumer, after 4, 5, 6 months of actually paying for that truck, they just stop paying for it. Well, now what happens? Well, that truck, maybe they paid down $500, but they're paying mostly interest at the beginning of that loan anyway. So now, okay, the loan value or what's owed on that actual vehicle, what that customer borrowed, is down to $14,500. But that truck is still now only worth $10,000 because that's what it was worth whenever they got the loan for that truck. There's $4,500 of deficiency of negative equity that's in that truck, and now that customer is still on the hook for that, but they're never going to pay it. And then you have thousands and thousands and thousands and thousands of scenarios just like this that's going to happen in the car market. We're already seeing it right now. Think back to Dodge Chargers and Challengers are my favorite example that have gone through the car market. This 2 years ago, what were consumers paying? Well, if the MSRP was $50,000, they were paying $10,000 and $20,000 over sticker for these Chargers and Challengers. Then the market dropped, right? And now, I mean, you could have gone in just in probably, 12 months ago, gone and got a Charger or Challenger for $10,000 under MSRP because of all of Dodge's problems. And it creates this $25,000 worth of negative equity that a lot of these consumers have built up. And what have they done? We see the delinquency rates. They just stop paying. And in a lot of cases, Carvana, CarMax, Wells Fargo is probably going to be the same way. We're going to see all of these financial institutions that are loaning all this money, they're going to try to kick the can down the road because nobody wants to say it. Nobody wants to say that we have a repo crisis on our hand. Right now we have an auto loan delinquency crisis, and we'll see that in the numbers, and we'll see that places like CarMax, they'll increase their loan loss provisions because they have auto loan delinquency problems. But they don't want to say the R word. They don't want to say that repo crisis word, right? Because that's when you start losing big time money. That's when you have people that are actually walking away from their loans. That's when you take the cars back to auction, try to dump them. That's when you start flooding the market with a bunch of junk inventory that a lot of dealers don't want to buy, so it doesn't bring a whole lot of money. That's when you have banks that lose tons and tons and tons of money here in the market. And it's very similar. It's not going to hit grand, it's not going to be a massive, wide-sweeping crisis like we saw back in 2008 with housing, but it's a very similar setup to what we see in the car market right now as to what we saw back in 2008 with a lot of lending with houses. And check this out, I can show you a little bit about what some of these repos actually look like. They're the worst kept cars in the car market and why I try to avoid them. Here's a Ford. I mean, you got burn holes in the seat from your cigarettes. You have seat covers. I don't want to lift it up because I can only imagine what's there. You've got, that's the engine cover that's in the back seat of this car. It's filthy, it's dirty, you got stains all in the seats, things I don't want to touch. Look, the seat has even been unplugged. There's a vent that's down there that's just loose under the seat. These are the kind of things you have. You have two different issues with a lot of these repossessed cars. You have cosmetic problems, people just tearing up the car, being nasty. You have things like scratches all over the hood. You can see where that car has been just absolutely destroyed. More dirt, and then on top of that, you have stuff like things being unplugged. You have things that don't work in these cars. And why would these people fix these cars if they know that they're not making the payments on it? They know that they're going to get repossessed, so they're not going to take care of any of these cars.